Every candlestick has a story, and if the high price shows the strongest moment for buyers, the low price reveals the exact opposite. The moment when sellers push the market into its lowest point during that session. The low price is the floor of the candle, the deepest point the market touched before being pulled back up. And just like the high, the low price holds powerful clues about strength, weakness, liquidity, and potential reversals. Think of the low price as the moment when sellers have full control. It's the lowest dip of the entire battle, the maximum pressure from the bearish side. But what makes the low price so interesting isn't just that it marks the bottom, it's the reaction around that bottom. Let's use a simple real-life analogy. Imagine dropping a rubber ball. The lowest point of the bounce is where the ball hits the floor, and what happens after? It bounces. The low price is just like that point of impact. Sellers push downward, but the market reaction tells you more than the low itself. Did it bounce aggressively? Did it stall? Did it break through? When a candle has a long lower wick, it shows strong rejection from that low. Sellers tried to push price down, but buyers came in hard and lifted it back up. That long wick isn't random, it's evidence that buyers defended that level. But if the candle closes near its low, the message is completely different. That means sellers dominated the session and didn't let buyers recover. The low price becomes a sign of weakness, showing bearish movement, showing bearish momentum. In bullish and bearish trends, low prices help define market structure. A bullish trend creates higher lows, showing that each dip is being defended at higher and higher levels. A bearish trend creates lower lows, showing sellers constantly gain ground. Just like highs hold liquidity above them, lows hold liquidity below. Stop losses from buyers sit under lows. Sellers stop from breakout traders sit under lows. Institutions know this, and they use it. They drive price below lows to grab liquidity before reversing. This liquidity behavior is so common that smart money concept traders often expect it, and the low price becomes the exact point where the sweep happens. It's not just the lowest point, it's the trigger for accumulation, reaccumulation, or reversal. Now, let's talk about the session lows. The daily low, weekly low, and monthly low act like magnets. They represent areas where institutions test demand, sweep liquidity, and look for imbalances to fill. If price approaches a session low, traders immediately watch for three things. Will it break? Will it sweep and reverse? Will it continue lower? The low price becomes the decision point. In candlestick patterns, the low is equally important. A hammer forms when price dips to a low and buyers absorb the move, creating a long lower wick. A selling climax happens when the market hits an extreme low with massive volume. A morning star begins with a candle that pushes into a deep low but then reverses. The low price also tells you a lot about the market sentiment. If price repeatedly rejects the same low, that level becomes support. Sellers keep testing it, buyers keep holding it. Eventually, something must break. Either buyers lose their strength or sellers get exhausted. And the low price is where this struggle becomes visible. Here's a simple scenario you will see often. Price is trending down and creating lower lows. Suddenly, it hits a new low, but this time the candle forms a long lower wick. Buyers step in aggressively. The next candle closes bullish. That next low wasn't continuation, it was liquidity grab before the reversal. You spotted it by studying the low price behavior. Even inside intraday trading, the low price acts as a gravity point. If price is above the daily low, traders lean bullish. If price is trading below it, buyers turn bearish. It's simple, but incredibly effective. But here's what makes the low price truly important. It reveals where demand lives. Wicks. It shows where buyers are waiting. It highlights exhaustion in downtrends. It signals liquidity sweeps and accumulation zones. And it helps confirm structure shifts. Let's wrap it up with one final analogy. Imagine the low price as the foundation of a building. If the foundation is strong, the building holds. If it's weak, everything collapses. Every time price hits the low, you're testing the strength of the foundation, and the reaction tells you everything. So, to summarize, the low price is the lowest point of the session. It reveals seller strength, buyer rejection, and liquidity behavior. It defines support, structure, and potential reversal. And in smart money concepts, lows are critical liquidity targets. Understanding the low price isn't just about identifying the bottom of a candle. It's about reading reaction, intention, pressure, and opportunity. Once you learn to interpret lows, the entire chart becomes easier to understand.